Hello and welcome back to my channel Accountancy Step by Step. Today we will learn about the system of accountings, accounting standards and IFRS. So just stay at home and study with me. In this video we will study about the systems of accounting. So systems, we have two systems of accounting. One is double entry system and one is single entry system. The system of recording transaction in the books of accounts are generally classified into two types: double entry system and the single entry system. So double entry system we have already studied, where we need to do the recording in two sides, double sides. Debit and credit should also be there. Two or more than two accounts will be affected. The principle of dual effect, which states that every transaction has two effects: receiving of a benefit and the giving of a benefit. Each transaction therefore involves two or more accounts and is recorded at different places in the general ledger. The basic principle followed is that every debit must have a corresponding credit also. If we are purchasing something, we are purchasing that by spending some cash, or we are purchasing that on credit. So goods will come over, and then if the creditors will be increased if we are purchasing that on credit, or we'll have to spend some cash, so cash will be gone. So two accounts will be affected. That is called the double entry system. Thus one account is debited and the other is credited. Double entry system is a complete system, as both the aspects of a transactions are recorded in the books of accounts. This system is accurate and more reliable because we are recording each and every transaction, as the possibilities of frauds and the misappropriations are minimized. If we are doing the double entry system, like see in this example, accounts payable 4020, purchase discounts and cash. So now if we see, debit and credit, both sides are equal, so no arithmetic inaccuracy is here. So as the possibilities of frauds and misappropriations are minimized, the arithmetic inaccuracy in the records can mostly be checked by preparing the trial balance. This trial balance we will study further. The system of double entry system can be implemented by big as well as small organizations. Okay. So the second part of system of accounting is single entry system. We have just studied about the double entry system. This is the single entry system. Single entry system is not a complete system of maintaining the records of financial transactions. So by the name, this is mentioning single entry system. Only one or the single entry would be there, no double entry. It does not record two-fold effect of each and every transaction. Instead of maintaining all the accounts, only personal account and the cash book are maintained under this system. In fact, this is not a system but a lack of system, as no uniformity is maintained. Of course, if we are not recording both the legs, then it will not be uniform. Maintaining the recording of the transaction. For some transaction, only one aspect is recorded, for other both the aspects are recorded. Like if we see on a shop or the supermarket, they can make the record in their own way. So this is their wish, whether they need to record on the double side or on the single side. So that is not uniform. Only one aspect is recorded, for other both aspects are recorded. The accounts maintained under the system are incomplete and unsystematic and therefore not reliable. The system is, however, followed by the small business firms, as it is very simple and flexible. You can amend it as per your wish or as per your requirement. So this is not trustworthy, this is not reliable. This is called a single entry system. Okay, so system of accounting we have studied. Double entry system and single entry system. Now the basis of accounting. What are the basis of accounting? We do the accounting, but on which basis we should do the accounting? From the point of view, the timing of recognition of the revenue and the cost, we have studied about the GAAP, and recognition of the revenue was there. rule and the concept and the principle was there, on which we have studied about the revenue realization. When we realize that the revenue would be there, doesn't matter whether we have received or not. So that is called the revenue recognition principle. There can be two broad approaches to accounting. These are, one is cash basis. So cash basis will be totally different, and accrual basis, this is different. Okay, so accrual means, if doesn't matter you have received or you have paid, you'll have to record when this is accrue or when the revenue recognized. Under the cash basis, entries in the book of accounts are made when the cash is received or the paid, or not when the receipt of the payment becomes due. When it dues, doesn't matter. We will do the accounting entries on the basis of cash receiving or cash going. Let us say, for example, in the office rent for the month of December is paid in January 15, whether it was due for December 14, but we have paid it in January 15, so it would be recorded in the books of accounts only in the January 2015. So this is on the basis of cash basis. Accounting we are doing on the basis of cash basis. The second base of accounting is accrual basis. So now think about the revenue recognition and then learn about this. Under the accrual basis, however, revenue and cost are recognized in the period in which they occur rather when they are paid. So paid is something different. When the cash will go out, that is different thing, and the revenue recognition is different thing. A distinction is made between the receipt of the cash and the right to receive cash and the payment of cash and the legal obligation to pay cash. So this is the right. We got to know that we'll have to pay. Thus, under this system, the monetary effect of a transaction is taken into account in the period in which they are earned or realized rather than in the period in which the cash is actually received or paid by the enterprise. So both are different. Two bases of accounting we do use while doing accounting. One is the cash basis, when we receive the cash, or when we pay the cash, when we actually deal with the cash transactions. And the other one is the accrual basis, which will work on the basis of revenue recognition. When you get to know that this is due, we'll have to pay. So we do the accounting on the basis of just recognition. So that is called the accrual basis. Accounting standards. Accounting standards are written policy document. These are the written policy documents. So documentation we have as per the accounting standards, covering the aspects of recognition, measurements, treatments, how we are entering the transaction. So that is called the treatment. Recognition we have already studied, money measurement, presentation, and the disclosure of accounting transaction in the financial statements. So accounting standards are the written documents of every aspects of accounting, like recognition, measurements, treatment, presentation, disclosure, or the reporting also. Accounting standard is an authoritative statements. Authoritative statements issued by the ICAI, a professional body of accounting in our country. ICAI is the professional body of accounting in our country. So that is authoritative statements mentioned by ICAI. The objective of accounting standard is to bring uniformity in different accounting policies in order to eliminate the non-comparability of financial statements for enhancing reliability of financial statements. So we have already studied about the comparability of the financial statements just to enhance the reliability. So the accounting statement should be like this. We can compare all the statements from our previous accounting, previous records, or we can compare that with different firms also and other organizations also. So if the accounting statements are comparable, then reliability will also enhanced. So on the basis of written documentation of the accounting standards, the accounting system can be uniform. Those are called the accounting standards. Okay, so now we have studied about the accounting standards. These are prepared just to maintain the uniformity and the reliability of the accounting informations. Now, what is the need of accounting standards? Accounting extends the information to various users. Accounting information can serve the interest of different users only if it possesses uniformity and the full disclosure of relevant information. So these should be reliable and uniform so that the third party can easily trust on those. If it possesses uniformity and the full disclosure of relevant information, there can be alternate accounting treatment and the valuation norms which may be used by any business entity. So any business entity can use any accounting treatment, valuation norms, but accounting standards facilitate the scope of those alternatives which fulfill the basic qualitative characteristics of true and fair financial statements. So accounting standards are here just to maintain all the qualitative characteristics in any accounting system so that those will be reliable and uniform and anyone can easily trust on those information. So this is the need of accounting standards. So as of now, we have studied about what is accounting standards and the need of accounting standards in any accounting system. In this slide, we will study about the benefits of accounting standard. What are the benefits if we are following the accounting standards in our accounting system? Accounting standards helps in eliminating the variation if there are some variation. So accounting standards helps us in eliminating the variation in accounting treatment to prepare the financial statements. So if in our accounting system, accounting treatment we are doing, here are some variations. If we are using some different method, if we are doing some using some different scope, so accounting standards eliminates those variations so that the accounting systems or our financial transactions, financial records will be reliable. Then accounting standard may call for disclosure of certain information which may not be required by law, but such information might be useful for general public, investors and the creditors. So this can be called anytime by any user. All those informations will be there because the financial institution will use the accounting standards now, and all the informations required by the accounting standards would be there. So easily can be disclosed. Also, these would be reliable for the general public, investors and creditors. Accounting standards facilitate the comparability, which we have studied in our earlier slide also. Comparability is very important characteristics of accounting. So accounting standards facilitate this between the financial statements of inter and intra companies. Okay, so intra companies comparison is very important while we are making any records. We should have the treatment of accounts like this so that we can easily compare those with our previous accounting period as well as with the different organizations. So accounting standards facilitate this comparability because we'll have to use some rules and regulations described by the accounting standards. Now, after the benefits, we will study about the limitations. What are the limitations if we are using the accounting standards? If we are following the accounting standards in our accounting system, what are the limitations? Accounting standards makes choices between different alternate accounting treatment difficult to apply. Of course, because we'll have to use the accounting standards. So different treatments like single entry system or any other thing we cannot apply. will have to follow the rules and guidelines described by the accounting standards. It is rigidly followed and fails to extend flexibility in applying the accounting standards. Again, if we want to, if we want to apply any flexibility, we cannot do that. It is rigidly followed. So these rules are rigid and we'll have to follow that, and fails to extend the flexibility. If we want to make our records flexible as per our requirement, we cannot do that. We'll have to follow the rules and regulations as described by the accounting standards. Accounting standards cannot override the statute. The standards are required to be framed within the ambit of prevailing status 2020. So there would be some guidelines and the rules and regulations which every financial institution has to follow. We cannot override that. So now the next slide will tell you the applicability of accounting standards. Where we'll have to apply the accounting standards. Benefits and limitations we have covered. So where we will have to apply all these accounting standards, except the purely charitable organization or the non-profit organization, charitable organization which does not have any commercials, industrial and business activities, accounting standards is applicable to. So only for the charitable organization we can leave the applicability of accounting standards. Apart from charitable organization, we'll have to apply these standards into sole proprietorship, partnership, societies, trusts, Hindu undivided family if they are doing any business, association of persons, cooperative societies, any companies, international financial reporting system. These all, of course, all the financial institutions would be out of all these. So everyone should follow this, and the accounting standards will be applicable in all these organizations. So now we have studied about the benefits and the limitation of accounting standard. This slide will tell you what is the basic need of IFRS, why we would require IFRS. So the important economic decisions are made on the basis of financial statements, which we make on the basis of financial records and the reports and recording of financial transactions. So everything is based on the financial statements. In order to avoid any manipulation of the figures in the financial accounts, there is a need for consistent way of deciding which elements require the recognition and measurement and how the information is presented in the financial statements. Hence, the IFRS helps to prevent the material manipulation or errors in financial statements. So, this is actually necessary just to avoid the accountants to manipulate the figures as per their convenience. If something is standard, some rules and regulations are standard, then the information and the statements will be more reliable and uniform. So that is the need of IFRS. IFRS helps in global harmonization. So here is the word global harmonization. IFRS helps. Unless accounting activities are regulated, different countries will apply different set of accounting rules as per their convenience, and the regulations are prevalent in each country. This will restrict the uniformity. Of course, if anyone is using rules and regulations as per their convenience, as per their requirement, then uniformity will not be there, and comparability of financial statements will also restrict. Hence, IFRS promotes the global standards for each of the business growth. So here is the need of IFRS, just to promote the global standards for each business growth. It facilitates global investment. The convergence of financial reporting and accounting standard is a valuable process that contributes to the free flow of global investment. If the business should be will be uniform and comparable, then global investment will also be grown and achieves the substantial benefit for all the capital market stakeholders. So for the globally uniformity and the reliability, we should have proper IFRS activated in all the financial statements. So this is the need of IFRS. About more information about this, we will study in the next chapters.
Thank you so much for watching my video. Please subscribe and click on the bell icon.